now let's talk about IT. The IT index was down 8% last week. It saw its biggest weekly fall in over a year. And the Nifty IT index erased a market capitalization of nearly 3 crore last week. Ravi Menon, IT services analyst at Macquarie Capital, now joins in to tell us where we go from here. Ravi, do you think it's overdone? What did you analyze of the deep fall correction seen? And what is the advice you're giving investors, your clients?
Anyway, even last week, when we saw claims of Palantir's, SAP migration and also the new drop by Anthropic, we had put out a note saying that this is, don't worry too much about this. There are productivity tools, but they're not going to replace a lot of this. And I think that people underestimate the demand elasticity in technology. Right? That's one mega trend, I would say. Another mega trend is actually cost of coding has always been dropping. So I don't think that this actually changes much. So if you look at, say, what Anthropic has provided, that maybe changes the business case from if you were a CFO and you're thinking about a new project, you may actually not even think about one which doesn't have at least, say, 500 business users or 1,000 business users. Now, if the cost to code comes down dramatically, you may actually start thinking, I can do this for a team of even 20. And maybe for the C-suite, why not create specific apps just for them? You can do all that, and when you're doing that, I think people who are going to build that, that'll still, because this is a one-time project, I think you will see this come back as good demand for India IT services. And the other concern is that people think, you don't really need to know how to code anymore if you're using these tools. Similar thing, I think, was a concern when low-code, no-code tools made their appearance. So back in 2012, 2013, especially around the 2016-17 time when these tools started gaining traction, this was a concern. But that's actually become the fastest growing practice for Indian IT services firms over time. Right? So I don't think that people should worry too much about this. Yes, firms should adopt these tools, and they'll have to change the business model a little bit, price a lot more on outcome. So that those changes will be made. But I don't think this is anything significantly disruptive.
Sorry, Ravi, morning. You started with it. People seriously underestimate demand inelasticity, right?
Not elasticity.
Elasticity. Okay.
So okay. The idea is that you have demand that grows a lot more. So if there is a slight drop in price, so elasticity greater than 1, demands actually, grows more than that.
I see. No, I meant to. I thought because the concern was that IT, IT budgets and software spending on software, etc., will go elsewhere. That's the question about that demand is inelastic, so that much spending will continue to happen. But anyway,
demand is highly elastic. I think that's a mistake, Prashant. Exactly, that's the problem. So people actually think of this as this is an existing pull. But you look at what we've come to, right? If we were still in the era...
No, so you are arguing that if there is $100 spent on software, that 100 can go up meaningfully. That's what you're saying.
It can, and that's actually what we've seen with mid-office and back-office spends actually moving away. So if you look at total operational budgets for a bank, for example, right? The last 20 years, we've seen a lot of automation. And ideally, you'd have expected that operational budgets include IT budgets within that. IT budgets have kept rising. And has anyone wondered where that budget has come from? Part of it's because it's come from the ops budgets where the budgets have shrunk. So IT budgets will continue to grow, in my view, and where it comes from will be, the pockets of productivity that it creates within the enterprise.
But Ravi, what earlier took, say, 50 engineers can now be done with 10 engineers plus AI. Is that a correct way of assessing? And therefore, is there not a risk to earnings expectations? Could we still see earnings downgrades?
So, Ravi, that's exactly what I was saying, right? That you will see that it may not be 50 to 10. At least not immediately. That might be set 10 years out. But when this process happens, if the cost to code comes down, you will actually change the ROI assumptions of a lot of new projects, right? So you will actually sign off on a lot more programs. For example, people would not have built, all the applications that you have built in the last 20 years if we didn't have a lot more productive coding, right? If you were still using punch cards to program, I mean, we would not be having this conversation over technology like this. Right?
So you don't see earnings downgrades for the Indian IT sector, and now at current levels, IT is a buy?
Yeah, we actually think that there will be a significant PE re-rating when the guidance comes out in April. So we think that this year demand's actually looking a little bit better, and when people realize that fears of disruption are overdone, I mean, I think that people have conflated the low demand in the last couple of years along with and confused that with the impact from AI. I think that's just a macro issue, a lot of uncertainty. And when there is a lot of technology change, people have also been reluctant to invest because they're worried that what they invest in will actually be made redundant by the time that investment is finished.
Yeah. Ravi, just a couple of quick points. Sorry, we're running into market open. You're saying expect significant PE re-rating in IT stocks, IT services stocks.
Correct, because I think when you see that the guidance is actually up, people will understand that the disruption that they're fearing is actually not here yet.
All right. So, and when the next year guidance comes through, right. Okay. So here and now, what should investors do? Those who are watching, Ravi, should they start to dip their feet in, buy a little bit of quantity and kind of sort of average? What's the advice?
Yeah, so we think that we think this is a time to start buying fairly aggressively. I think the worst case that I see is another 10% down in some of the large caps where, for example, for HCL Tech, then you start bumping up against the 10-year GSEC yield level in free cash flow terms. And I do not think that the free cash flow is going to reduce for these firms, right? I am still optimistic about growth and growth starting to pick up. And I think we will see that be a good buying opportunity.
And worst case, 10% decline from here on, right?
That is what we're thinking.
Ultimate bear
That's
case.
Correct. That's right.
Yeah. Is there an ETF that one could buy, an IT ETF or something? I mean, then, or maybe, or just.
Yeah, there are ETFs.
Yeah. Okay. That's maybe a better way to get exposure, right? I mean, or maybe individually as well. If you had to leave us with one name, best placed, what would it be?
So, see, our top picks continue to be TCS and HCL in the large cap space, and Persistent Systems and Coforge in the mid caps.
Okay, that's clear. Ravi, thank you very much. Good conversation. Appreciate it very much here on CNBC TV 18.